What if I told you that some of the biggest banks in the world, including JPMorgan and Goldman Sachs, might be quietly betting against silver? Imagine waking up tomorrow to find that the metals you trusted to preserve wealth are being manipulated behind closed doors. That's the reality revealed in an emergency memo leaked to a select few. Today on Iron Ledger, we're breaking it all down so you can understand what this means for your money. Before we dive in, take a moment to like this video and subscribe. On Iron Ledger, we explain complex financial dramas in simple, clear terms for everyday viewers. The memo shows that JPMorgan and Goldman Sachs may have taken aggressive positions betting that silver prices will drop. For many retail investors, this news might come as a shock. Silver has long been considered a safe haven asset, a hedge against inflation and currency risk. Yet the very institutions that influence the global market are taking positions that could suppress its value. Silver is not just a precious metal, it's an industrial metal used in electronics, solar panels, medical devices, and green technologies. Its value is driven both by industrial applications and its role as a store of wealth. When banks and hedge funds bet against silver, they are shaping market perceptions. Every move can influence supply-demand dynamics in ways most investors don't see. The leaked memo reportedly outlined strategies to benefit if silver prices fall. This could include short-selling contracts, futures positions, and other financial instruments. While these practices are legal, they raise ethical questions. Large institutions can impact markets in ways individual investors cannot. Silver is more susceptible to large trades than gold because of its smaller market. Every move by a bank like JPMorgan can ripple through the market and affect prices globally. Investors rely on silver to protect against inflation and currency risk. When major players bet against it, it creates tension in the market. This is why watching these memos is essential for anyone serious about preserving wealth. It's not about fear, it's about knowledge. And Iron Ledger exists to uncover these complex dynamics. The market may appear calm, but memos like this show strategic maneuvering most investors are unaware of. Large banks quietly shape prices and sentiment, and historically, silver manipulation is not new. Understanding these patterns helps interpret current events and gives insight into why silver behaves the way it does. The memo highlights tension between industrial demand and financial speculation. Silver demand is increasing due to electronics and green technologies. Speculative trading by institutions creates price volatility unrelated to real supply and demand. Timing strategies are critical, as banks plan trades around economic reports, central bank announcements, and geopolitical events. This level of coordination is rarely available to ordinary investors. By understanding timing, you can make smarter entry and exit decisions. Psychology drives market behavior, and when large institutions bet against silver, it creates fear, prompting panic selling among retail investors. This amplifies downward movement, creating opportunities for those with knowledge and patience. Watching trends closely can help you navigate volatility without reacting emotionally. Regulatory oversight is another factor. While these bets are legal, questions about fairness and transparency arise. Leaked memos shed light on institutional influence and potential conflicts of interest. They reveal hidden forces shaping commodity prices. The memo outlines worst-case and best-case scenarios. Prices could drop significantly in the worst case, while strong demand could counteract downward pressure in the best case. Knowing both possibilities helps investors plan strategically. Economic factors like inflation, currency fluctuations, and monetary policy all influence silver pricing. Central bank actions interact with speculative bets, creating a complex web of market influence. Awareness allows better decision-making and helps investors navigate hidden pressures. The memo shows how banks coordinate across multiple instruments. Futures, options, ETFs, and derivatives are all used strategically. Understanding these tools explains why silver prices sometimes move counterintuitively. Sudden drops or rallies may not reflect real supply and demand. Industrial demand continues to grow. Silver is essential for green energy, electronics, and medical devices. This demand provides a natural floor for prices, even amid speculative trading. Investors who understand this have an advantage. Hedge funds, pension funds, and private wealth managers are closely tracking leaked memos and market signals. Their moves add layers of influence. Despite institutional positions, global demand fundamentals remain strong. Silver's dual role as a hedge and industrial metal ensures long-term stability. Geopolitical events also affect silver prices. Trade tensions, sanctions, and policy shifts create volatility that banks can exploit strategically. Recognizing patterns around these events helps investors prepare rather than react. Even retail investors benefit from understanding these dynamics. Following institutional behavior and global trends helps protect wealth. Iron Ledger's mission is to connect the dots and explain market behavior in clear terms. Historically, silver has been targeted for manipulation. Precedents exist from past crashes and speculative positioning. Recognizing historical patterns today can help navigate risk effectively. Market transparency is a recurring theme, as information asymmetry gives insiders an advantage. Understanding these dynamics allows better financial decisions. It reduces the risk of reacting blindly to market moves. Industrial demand, global economic conditions, and institutional positions all interact to shape silver's price. Economic developments, inflation reports, and trade policies affect prices in real time. Observing these trends allows anticipation rather than reaction. Fear, uncertainty, and anticipation drive market behavior. Institutional bets can influence sentiment. Technological growth further supports silver demand, with renewable energy, consumer electronics, and infrastructure all requiring silver. Historical context matters. During monetary stress, gold and silver maintain value while fiat currencies suffer. Understanding these patterns allows investors to protect wealth proactively. While JPMorgan and Goldman Sachs may bet against silver, industrial demand and retail accumulation provide upward pressure. This tug-of-war creates volatility but also opportunities for patient, informed investors. Silver's fundamental value remains resilient despite institutional manipulation. Limited supply, industrial necessity, and hedge properties make it unique. Leaked memos remind us markets are not random. Large institutions shape outcomes, and being aware helps ordinary investors navigate wisely. By understanding these dynamics, investors can anticipate moves and protect wealth. Iron Ledger simplifies these complexities to empower viewers. Engage with this video, share your thoughts in the comments. Do you believe JPMorgan and Goldman Sachs can suppress silver, or will demand push prices higher? If this analysis helped, share and subscribe to Iron Ledger for insights into financial markets, institutional strategies, and the global economy. Understanding these forces helps anticipate market moves, protect wealth, and make informed long-term decisions. Silver remains a quiet signal of global financial truth. Watching it closely is essential for investors. Awareness today puts you ahead of the curve when financial realities shift.